if Bitcoin performs, if it appreciates 10% a year, then the equity outperforms Bitcoin because the leverage is all accretive. If Bitcoin goes up 4% a year, then the equity is mildly underperforming Bitcoin over time, probably, although we have the float and a lot of optionality there that we can use. But between 3% and 10%, the equity may underperform Bitcoin, right? If Bitcoin, falls 10% a year, then the credit will become distressed debt. So if you're a credit investor, don't buy the credit if you think Bitcoin's falling 10%. That's obvious. If you're an equity investor, don't buy the equity if you don't think Bitcoin's going to go up more than 10%. And everything in the middle is just managed by the company.
Another major theme of Saylor's argument is that investors often misunderstand the relationship between Bitcoin price movements and company performance. He explains that if a company raises billions of dollars by issuing equity at a substantial premium, the subsequent Bitcoin purchases were effectively funded by investors willing to pay significantly more than the value of the underlying Bitcoin itself. As a result, even if Bitcoin later declines in price, the company may still be better off than if it had never raised the capital in the first place. This is a crucial distinction. Many analysts focus exclusively on unrealized gains and losses resulting from Bitcoin's price fluctuations. Saylor argues that such accounting measures can be misleading because they ignore how the Bitcoin was acquired. The origin of the capital matters. If Bitcoin was purchased using highly favorable equity financing, then temporary declines may not meaningfully impair the long-term economics of the transaction.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
So it turns out if you want to invest in the equity of a publicly traded company and you want to do it responsibly, you have to actually have an attention span, which means you have to read the filings and look at the conference calls. There are 100,000 pages of SEC filings on our company, and there's thousands of pages that cover the balance sheet and what we've done, what we're going to do. So if you're assessing our business, for example, a lot of misnomers fly around. The idea that selling equity is dilutive is a misnomer. The truth is it's massively accretive. If you calculate assets per share or net assets per share after adjusting for the liabilities, everything we're doing is accretive, whether we swap equity for Bitcoin or swap equity for cash. So that's the first observation. Second, the actual gain or loss on the Bitcoin position is totally irrelevant if you actually bought the Bitcoin substantially with equity. If you sell, all of the Bitcoin we purchased was 80% of it was equity. So at all points in time, we sold it at a premium that was higher than the net asset value. So we sold, I think we raised $21 billion of equity in a matter of months in 2024. We did it at a premium of 200% over the Bitcoin. So we raised $21 billion of equity. We bought $21 billion of Bitcoin. We banked a $14 billion Bitcoin gain. It doesn't matter whether the Bitcoin trades down 30%. You would show a $4 billion loss, but the point is you bought the Bitcoin with equity that was triple the current price. So you have to actually keep in mind that when you're actually swapping equity for Bitcoin, the only thing that really matters is did you do it at a premium to net asset value after adjusting for liabilities, right? And you have to adjust for all the liabilities on the balance sheet. Was it at a premium to net asset value? And it is. I mean, there might be a couple of days in the history of the company where we didn't do that, but it would just be a few days. And the second issue is, if it's equity, if you can sell $100 billion of equity at $1,000 a share, and the equity trades to $100 a share, and the Bitcoin trades down 80%, do you really care that you're showing an $80 billion loss? You still actually are better off than if you hadn't sold the equity in the first place. So if you're actually buying Bitcoin on margin credit, when you're buying it with a loan that comes due next week, it matters what price you paid for it. If I borrowed $1 billion from an exchange and I bought the $1 billion and it traded down 50%, that's a problem. If you're buying it for long-dated duration debt, it's much less of an issue. When you're buying it for a hybrid instrument like a preferred stock, well, the issue with the preferreds is all the options switch. So the stochastic cost, first of all, the preferreds never come due, and the stochastic cost of capital is lower than the nominal cost of capital because of all the options that accrue to the issuer. For example, with STRC, we have the option to lower the dividend when SOFR falls. We have the option to lower the dividend on, the credit spread when we want. We have the options, to delay the dividends if we need to. Those options are obscenely valuable to the issuer. And a simple way to look at it is if you're paying 11.5% right now, probably the real cost of capital is 8.5% over 20 years. And because the principal never comes due, you can't ever have a liquidation event. It's a continuous cost. So let me boil this down to a simple observation. If you think that Bitcoin is going to appreciate more than 8.5% a year, then all of our Bitcoin gains are net income. If you don't think Bitcoin's going to appreciate, if you think it's going to appreciate 0% a year, we have like 30, 35 years before we run out of money. And our assumption is if you think the Bitcoin's going to appreciate 3.2% a year, we pay the dividends forever without selling a share of stock. Okay, and how long do we have for Bitcoin to trade 3%? What's the duration? 30 years. So over 30 years, the bet that the equity bet and the credit bets are this. The credit bet is over 30 years, Bitcoin will appreciate 3% or more. And if it doesn't, the credit quality deteriorates. That's the credit bet. And, the company can pay the dividends literally forever at 3%. The equity bet is that Bitcoin's going to outperform the cost of capital of the company, which, again, most people can't calculate it. They don't really understand it, but probably it's like 8 or 9%. But let's just make it easy, 10%. If Bitcoin performs, if it appreciates 10% a year, then the equity outperforms Bitcoin because the leverage is all accretive. If Bitcoin goes up 4% a year, then the equity is mildly underperforming Bitcoin over time, probably, although we have the float and a lot of optionality there that we can use. But between 3% and 10%, the equity may underperform Bitcoin, right? If Bitcoin, falls 10% a year, then the credit will become distressed debt. So if you're a credit investor, don't buy the credit if you think Bitcoin's falling 10%. That's obvious. If you're an equity investor, don't buy the equity if you don't think Bitcoin's going to go up more than 10%. And everything in the middle is just managed by the company. But I think a lot of times people, they'll do things like they'll say, well, you have to sell at this price to get a positive yield. Well, a positive Bitcoin yield, but the truth is, the hurdle rate for accretion on a US dollar basis is lower. And so the challenge with Bitcoin treasury companies is you have to be simultaneously calculating on a US dollar standard and a BTC standard at all times. And you have to also evaluate liabilities and assets. Like a lot of times people think preferred equity is a liability. It's only a liability in liquidation. It's impossible to ever get to liquidation. That's the only way to get to a liquidation event is for the debt to come due. And so if there's no debt, like your company, or if I have de minimis debt, you're never in a liquidation. But since you're never in a liquidation, the preferred equity isn't a liability, it's an asset, and it's equity. So the thing that breaks people's brains is if you assume that you're in a liquidation, then you can think that digital credit is a liability, and then you can be all gloom and doom. But since it's impossible to get to a liquidation based on purely digital credit, the only way to liquidate, to get in a liquidation event is you have to have debt that comes due. So it turns out when you're running one of these companies, you have massive optionality, and you have control over when you finance things. So most of these narratives, they start with, well, let's assume that Bitcoin falls 80% and never recovers, and then you're in liquidation, then you've got a problem. And the truth is, with every single business on earth, if you start with, let's assume that all of your assets deteriorate 80% and you're in liquidation and they never recover. There is no business on earth that doesn't look dour if you just make that assumption. But if you start to think a bit more, a little bit more thoughtfully about it, you realize, well, how do I actually ever get to that point, and what does the world look like? And the truth is, the businesses are pretty anti-fragile, and as the equities fall, the amplification increases, and they just get more compelling. So just like digital credit tends to be self-healing and snaps back to par, if Bitcoin crashes, the demand for digital credit falls, which means the credit worthiness and the forward look, the credit profile looks better in the future. And the same is true with the equity. So we're attracting demand for the credit and demand for the equity as the assets trade down, and that's what creates the stability for them to trade back up again.
One challenge facing Bitcoin treasury companies is accounting. Traditional accounting standards were not designed around large Bitcoin holdings. Consequently, reported earnings may not always reflect underlying economic reality. Saylor argues that Bitcoin gains should be viewed similarly to net income if Bitcoin's long-term appreciation exceeds the company's cost of capital. For example, if Strategy generates billions of dollars in Bitcoin gains while financing costs remain lower than Bitcoin's growth rate, those gains effectively create real shareholder value. The market's interpretation of these gains, however, depends entirely on future expectations. An investor who expects Bitcoin to rise 30% annually will value those gains very differently from someone who expects Bitcoin to decline. This explains why opinions about the company vary so dramatically.
If you think Bitcoin is going to appreciate at about 10% or about our cost of capital, then when we report a Bitcoin gain, that is comparable to net income. When we have a $5 billion Bitcoin gain this year so far, we're on track to maybe get to 10, but we had like just slightly south of 10 last year. But if we report a $5 billion Bitcoin gain, for you to believe that that is valuable, you have to assume Bitcoin is not falling to zero tomorrow, right? If you think that Bitcoin is falling 10% a year, then Bitcoin gain isn't that interesting because you're discounting it 10%. But if you think that Bitcoin's going up 0% a year, then we might have incurred a liability. We sold Stretch to buy the Bitcoin. I get it. If you think that Bitcoin's going up 10% a year, I sold $1 billion of Stretch to buy $1 billion of Bitcoin. I'm never paying the money back. The Bitcoin I bought with it is paying the dividend cost because it's going up 10% a year and it's compounding. So the truth is, if Bitcoin could probably go up like 8% a year and we could probably have a cost of capital of 10%, all of the gain is net income. If you think Bitcoin's going up 30% a year, when we report a $5 billion Bitcoin gain, that's like $15 billion. It's $5 billion up front, and it's probably another $10 billion on the back end. So the business has obscene profitability, but the reason it's so controversial is your view of the equity is going to have to be it's going to have to be modulated through your view of the forward Bitcoin price. Just like your view of the credit has to be modulated through your view of the forward Bitcoin performance and the Bitcoin vol. And you can come to an opinion that the credit is distressed and the equity is awful if you have a negative Bitcoin position or opinion. And you can come to an opinion that we're going to dramatically outperform Bitcoin and generate 50% a year, which is like sort of what we've done for the past 5 years, and that the credit is all investment grade if you have a positive view toward Bitcoin. And since most of the people that are in the market have very divergent views or don't even articulate what their view is before they express an opinion, that's why you get so much controversy and back and forth on that matter. On the second one, Satoshi seems to be it's a number of wallets, and there's like a bit more than 1 million Bitcoins, so I suppose Satoshi is the largest holder. On the first question, we actually have a bunch of ATMs. We have ATMs on the perpetual instruments like STRD, STRF, STRK. We have an ATM on the common equity MSTR, and we have an ATM on the credit instrument STRC. And so they're all dynamically adjusted and programmatically run based upon a set of parameters, and it's a function of the equity capital markets, the credit markets, the Bitcoin market, our decision about what to buy or what to sell or what to swap. It's not just adjusted weekly or daily, but it's literally adjusted minute by minute. So what you'll see is we think that, and we have other options, like for example, we could go out and sell bonds. You'll notice we have 6 bonds outstanding. We haven't sold any more bonds. We'll retire all the bonds, so that's just turned off. The debt part of our business we don't see as being strategic or advantageous. You'll notice in our 8K filings we haven't sold any STRD, STRF, or STRK. That's because we think they're undervalued. The cost of capital would be too high, and we'd be locking in that dividend too long, perpetually. So what I would say to you is, if you like Bitcoin and you like the company, you should buy those things, because I'm not selling those things, right? Like, I wouldn't sell them, right? Because I think they're too expensive as a form of capital and they're undervalued. And so we do actively manage that, right? If STRF were to trade to $200 a share and the cost of capital is 5% for perpetual money, maybe we might start selling it again. So, and we consider that based upon SOFR and the forward yield curve and the credit markets and the like. With STRC, we won't sell at a penny below par, and we will sell a lot of it at a penny above par, and that's because one of the primary functions of that is to strip all the volatility, and that's how we do it, and to support the instrument. We allocate to, our capital to buying Bitcoin or buying dollars, depending upon the credit markets and where we are. And, we're swapping back between buying debt, buying dollars, buying Bitcoin. We've sold some Bitcoin. We sell credit. We sell dollars to buy swap dollars to buy the bonds. So there's a lot of things we're doing. They're all just dynamically adjusted, and it's just a function of the forward curves and the premiums in the derivatives market, the capital market, the equity market, and all the credit markets, and they're all different, and we evaluate them all the time. Generally with the theme that we want to do things that are equity positive, like we're doing things accretive to the equity. We want to do things that are credit positive, things that are supportive of the credit, especially STRC, right? We've done a dozen things to support STRC. And then we want to do things that are Bitcoin positive, right? And sometimes the interest of those 3 groups are a little bit at cross purposes, and we have to balance those interests, one versus the other, and that's pretty much our business, right? Thinking thoughtfully all the time about those things.
Michael Saylor's argument can ultimately be summarized in one sentence. The success or failure of a Bitcoin treasury company depends less on short-term Bitcoin volatility and more on the relationship between Bitcoin's long-term appreciation rate and the company's cost of capital. Throughout the discussion, Saylor challenges conventional assumptions about dilution, leverage, liquidation risk, and accounting treatment. He argues that many critics analyze strategy using outdated frameworks that fail to account for the unique characteristics of Bitcoin-backed capital structures. Whether investors agree or disagree with his conclusions, one thing is clear: strategy is attempting to build an entirely new financial model where Bitcoin serves as the foundational reserve asset and capital markets become tools for expanding exposure to that asset over time. For believers in Bitcoin's long-term growth, Saylor sees enormous opportunity.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.